Here's a question I thought everyone was asking about. Did the market really bottom a few months ago? Or is this whole recent rally nothing more than a dream? With a rude awakening coming in the not-too-distant future that started today. Maybe when we hear from the Fed later this week, that's the big question right now. Are we still in a bear market, or have the broader averages transitioned to bull mode? At times like this, you know what you got to do? You got to check your emotions. Take them out of the equation. Assess the situation from a more quantitative perspective. So tonight we're going off the charts with the help of Mark Sebastian. Oh, Mark's a brilliant technician. He's the founder of OptionPit.com, also writes for RealMoney.com. I've been following his stuff for more than a decade. We got to find out and get a better read of the action, because he's our resident volatility expert. And volatility could be the key to understanding this moment. And I like this as a way to, let's just say, put it all in perspective. So first, take a look at the daily chart of the S&P 500. This is simple enough, okay? You can see very clearly that we made an important low in October. That's pretty clear, right? But from a technical perspective, a new low doesn't necessarily mean anything. For chartists, though, the real change came more recently when the S&P 500 broke out above its downward sloping downtrend. Boom, right here, right? Sebastian points out that from the S&P's peak in January of last year to the lower high on March 29th, to the next lower high in mid-August, to still one more lower high on December, the index just couldn't break through the ceiling of resistance. It just kept failing. We've seen that several times from several chartists. Every time we rally, we get this level, and then the market would come right back down. It happened again a couple weeks ago, on the 17th, too. But a few days later, on the 23rd, the S&P finally did break out above this level, and we've stayed above it for 6 straight sessions, which makes people pretty excited, including me, as long as it's broad. See, this chart has broken the negative pattern that's held us down for more than a year. So how meaningful is this breakout? As Sebastian sees it, we need to look at the CBOE Volatility Index, the VIX for short, in comparison to the S&P, because this gives you a better read on the underlying level of fear and trepidation on Wall Street. Normally, the VIX and the S&P go in opposite directions, right? Lower stock prices equals higher fear, so that's what you'd expect. But at pivotal moments, they'll move in the same direction, signaling that a trend is about to change, because a rally with rising fear is not going to last, and a sell-off with declining fear will be equally short-lived. Make sense? Check out the daily action in the S&P and the VIX going back to late 2021. All right, now this is really instructive. Sebastian notes that the 2-year low for the VIX came on October 21st, and we've highlighted that, of 2021, right when the market was starting to crest. You know, right there, okay? About a month before the Fed declared war on inflation and the bears started going on a rampage. After that October 2021 low, the VIX spent the next 2.5 months rallying like crazy, even when the S&P was rising. Bad sign for any move higher, right? Well, sure enough, the market peaked. The market marked the peak for the whole market. So this was that foreshadowed, and then nothing but down. Then after the peak, the VIX and the S&P go back to the normal relationship, with the VIX soaring while the S&P plummets. Eventually, the volatility index peaked in early March of last year, but that wasn't the bottom for the stock market, not even close. Why rehash last year's action? Because Sebastian wants you to notice what happened to peak volatility every time the S&P made a new low during the bear market. Now, take a look at this next chart of the VIX and the S&P from last February through the present moment. So now we're talking about right now, okay? See, every time the S&P made a new low during this period, Sebastian notes the VIX actually peaked at a lower level, okay? At the same time, let's look at the next chart. Just about every lower high for the S&P saw a lower low for the VIX. Okay, so what was going on here? How can the market be hitting new highs while the fear gauge seems to show that Wall Street's getting progressively less afraid? Well, here's where the volatility index can throw people off. Even though the VIX is really a way to measure the perceived future volatility of the S&P 500, it also does a very good job measuring the overall level of fright in the stock market. We call it the fear gauge for good reason. But here's how Sebastian sees it. What's the scariest part of a horror movie? It's not the actual axe murdering, right? It's the scene right before, when the suspense is building and you're just waiting for the killer to jump out of the closet. Then, bam! To Sebastian, the bulk of last year was the axe murdering. The most terrifying part, the jump scare, happened in the first quarter of last year. He also points out, if you take a look at this next chart, another thing. Over the last year, the new lows in the volatility index have been bought, and the S&P has almost immediately sold off hard. Some of the VIX pops have been shorter, like we saw last May or in December. Others have been longer, like the pop we saw in August that accurately predicted the oncoming obliteration of the S&P 500. Look at this. Boom. Now let's zoom in on the action in the S&P and the VIX over the last month so we can talk about the current moment. Sebastian really doesn't like what he sees here. Back on the 13th, the volatility index made a new low, okay? Since then, the S&P has continued to rally. The S&P's in blue. See that? Got the S&P. Yeah, it's continuing to rally. The black line says. Remember, when these two lines move in the same direction, it usually means you can't trust the action in the S&P. It's not going to be working. Because while the market's rising, the fear is rising too. So you've got both of these, S&P going up and fear going up. Sebastian thinks we're absolutely going to see a retest of the new floor of support at the 200-day moving average. If that floor doesn't hold, he wouldn't be surprised to see the S&P plunging to a new low around 3,400. So if that doesn't hold, he thinks we're going much lower. This is assuming something goes very wrong this week, maybe a much harsher than expected Fed meeting. Right now, Sebastian isn't sure whether the bottom from last October will hold. If the S&P can bounce off the floor created by the 200-day moving average, that's the purple one, if it bounces here, or even if it can just stay above the 3,800 line, which is right here, then rally for a couple of days, well, then, you know what, maybe we're going to be okay. Take that as a sign the rally's for real. However, if that floor doesn't hold, he could easily see the market revisiting its fall lows. If that happens and the volatility index makes a lower high rather than a higher one, Sebastian would be a buyer because he suspects that would be the bottom. Remember, if it shoots up, you're going to go lower. But the bottom line, the charts as interpreted by Mark Sebastian suggest that we're approaching a decisive moment here. If the S&P 500 can avoid a major decline this week, he's feeling optimistic about the future. On the other hand, if it gets clobbered, he sees a heck of a lot more downside. So watch the averages, watch the volatility index to see if the action is telling the truth. I'm feeling more sanguine than he is, but we'll have a much clearer picture in a couple of days, and now you know about how the VIX interchanges with the S&P and is not signaling good things, even as I think the S&P is broadening out, and I am in a better, more, I'd say, bullish fashion. Let's go to Brittany in California. Brittany.
Hey, Jim. I just wanted to say thank you for what you do for all us home gamers. You helped me save for my down payment when I was 26 in the Great Recession.
See, now that I just love to hear, because then I can tell Lisa, my wife, see, I am helping people, which is what we're always trying to figure out. Thank you very much. How can I help?
My stock is Northrop Grumman. So I bought this at $490, seeing it pulling it back to the bottom of its trading range. And then a small position, then I saw it get hit by all the downgrades. And I'm like, did I not do enough research on this stock? Because I'm looking at Lockheed Martin and Raytheon, and they've got a peg of half of what Northrop does. So I'm like, do I stick with my guns and go in at 430 right now and double down and go in more at 400, or do I go with Raytheon or Lockheed that give more?
No, you know what? It's a great question. I happen to be a huge fan of Lockheed Martin and Raytheon. But because Northrop Grumman has fallen so much, I think it jumps that whole queue and becomes the one you should be buying. So, Brittany, I think you're in great shape, and I would actually buy more tomorrow. And thank you for the kind words. It means a great deal to me, as did all the kind people who told me this weekend that they enjoy what we do on the show. Thank you. Tonight's chartist believes we are at a crossroads. If the S&P 500 can avoid a major decline this week, then he gets optimistic. If not, more downside. Very difficult. Crux moment. There's much more mad money yet, including my exclusive with Prologis. After putting a top and bottom line beat a couple of weeks ago, I'm digging deeper into the story to see what was behind the quarter's strength with the CEO. Then it's been 2 years since the apes entered the market. Laser focused on GameStop and AMC. So what's the real takeaway about what happened? I have a very tough look at what happened, and I'm going to give you my take. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.